So some of the pushback that we've gotten when we look at, well, what about inflation? We don't see it yet. It's not there. Well, we're looking at the supply chain. We want to look at the supply chain and find where the prices are and how far along the move are we, because this is going to be, I think, a bigger problem as it continues to extend, because while the supply chain issues are transitory, while all of that is true, what is transitory? What is the length of time in which it's going to be transitory? We were told in the middle of last year, it's transitory, it's going to go away, and then it keeps getting ratcheted up. Now, most recently with the Suez Canal, we continue to see price increases on raw materials, and this is only increasing that inherent cost at the exporting side. And then the importer, we still have cargoes that are in the middle of the ocean that are more expensive than the ones that we previously imported. And the ones that are getting loaded now are more expensive than those. So again, we continue to see this reverberate through the system, and we're going to look at this in a very specific way. So first, we're going to look at it from the aspect of the different feds. So let's look at Dallas Fed, Kansas, New York. Prices paid versus prices received. You can see that there is a huge delta between the two. And I'm not saying that they have to close, because they don't have to close completely, but there has to be some meeting in the middle. And based on what we can see with prices paid, those are going to continue to go up. So as prices paid go up, it's going to pull those prices received. And those prices received is what you're charging individuals. That is what is being charged to the end user. And for anybody that on Twitter, I was joking, my wife bought the Reese's peanut butter eggs for Easter, and she looked at it and she goes, "Wow, these are a lot smaller than they used to be." And I look up and I go, "It's inflation." And she goes, "I know. I just wanted to trigger you." So it's clear if you know where to look for it. When you look at products that are getting more expensive but smaller, and this is just showing you that they're going to continue to move in that direction when you just look at how people are going to be impacted as we go through April, May. And this is why when we think about stimulus delivery, so if stimulus is delivered in April of 2020 versus April of 2021, your prices are different. Obviously they're not at the levels that they should be in terms of that delay pass through, but they're clearly over where they were. And because in that dip, so when you look at any of these Fed surveys, that dip below zero was when you got money. And now we're well above zero, and now we're in positive territory, which means that we're accelerating these price increases. So your stimmy is not going to go as far as it really should, or as it did last year, which is going to minimize some of that impact. So then when we look at it on the regional side, so regional surveys, when you look at prices paid, prices received, you can see just the inherent growth that is going to continue to just drive this higher. And at some point we'll start to see a little bit of a flattening move in the prices paid. But again, the inherent supply chain, the additional lockdowns is just going to mitigate against that. And then when we look at it a little differently, of prices paid minus prices received and PPI minus CPI inflation spread, you can just see how big that delta really is and just where this is going to continue to go. So I don't see this prices paid coming down. Can it flatline? Absolutely. It's just when we look at when it flatlines, it continues to draw the prices received up. And that's where I think we're going to continue to see some of these movements. And we're going to really drive much closer to, I would say, even north of 3%. And then obviously zero hedge. You have to, obviously it's zero hedge. You have to appreciate for what it is, but they had a good article looking at, what happens when you actually normalize the way rent should be calculated. And when you do that just alone, you get to a CPI of 3.8%. So again, these are things that we have to consider when we're looking at these different numbers, as we talked about in the first segment when we looked at rent and overall mortgages. So then when you look at, well, what are manufacturers seeing in terms of inflationary pressures on the horizon, which is why, again, I don't see this going down, is because they're all projecting material prices to continue to go up. We continue to see that in general, which again is just driving us higher and supporting some of these movements. And then when we look at Purchasing Managers Index for input prices, this is not a U.S. entity. This is not a U.S. problem. This is global. This is raw materials. This is inherent inflation internally. So that's why when we look at Germany, Eurozone, U.S., Australia, Japan, we're seeing these impacts just around the world. And it's something that is going to become a much bigger issue as we see the inflation shift. Because when you get to 2019, when again we were talking about being fairly bearish, we had deflationary pressures. Those deflationary pressures are now gone, and now they're actually moving in the wrong direction to the upside, which is just going to keep some of this pressure, and it's going to keep us fairly capped in terms of, just what does that growth look like as those prices have to be passed through. Now, while those prices are being passed through, the Purchasing Managers Index for supplier delivery times is getting worse. So you're essentially going to scramble. You're going to pay extra, whether it be on a faster ship, on a plane to try to backstop, using more trucking instead of rail. This is also going to increase your overall cost as you try to accelerate this into the system. And it's happening everywhere. So again, these are things that are going to become more problematic when you start putting all of these prices together and they come up with what their unit price should be based on what their costs are. And then when you look at just the GDP hit, when we shift this a little bit differently. So we've gotten very used to very robust, or I should say very beneficial discounts in inflation and in pricing because of technology. So what happens when technology fails us? Where now we have a huge backlog where there's, you can't get chips. This is you're looking at EU share of wafer capacity used for Germany and Austria, Mexico capacity estimated based on national data. This is looking at just vehicles. So this is looking at trucks, cars. We continue to see that there's going to be a big GDP hit because Germany and Mexico obviously rely on them. Excuse me, and they're just not getting the amount of capacity that they need on the technology side. And those chips are getting more expensive because of raw materials, because of water, because of shipping, as we showed. So we've gotten used to, storage getting cheaper, CPU power getting cheaper. Well, it's not. Now it's actually getting more expensive. So not only do you have a base effect, but now you've reached this terminal, the end of this terminal velocity, which is going to drive us higher over not only just the short term, but also the medium term, which is putting some of this capacity behind where we see inflation going. And this is just some data points showing you where. So when we look at Taiwan Semiconductor, you can see just what they drop into. When you look at Texas Instruments, ST Microelectronics, NXP, Renesas. So you can see Apple, Samsung, Tesla. It's becoming a bigger issue where all of these computers, when you strip them out and you look at the pricing in general, this is televisions, how many people try to buy a TV and couldn't get it, or had to go to a different model because it wasn't available. This is going to become that bigger issue, and based on how it originates with TSMC, which is really capped by the amount they can go, you can see just how long and how deep that goes, especially when you look at Toyota, Ford, Continental, Apple. This is where it's not just tech. It's not just computers, because everything, microwaves, refrigerators, washer dryers, dishwashers, they all have microchips. And this is a big issue when you look at just the amount that needs to be consumed and how far we are from meeting that demand. And that's why when we look at other types of bottlenecks, so when we look at chip designer and semiconductor firms, well, what happens if the microchip is slowed? What happens to the storage? What happens to the motherboard in general? What happens to the graphics card? This is where you start to see some of these issues in general, and cost for customer. So the cost from the customer continues to, again, push down through the system, where if Qualcomm increases costs, Apple's going to increase costs. If Broadcom does, Apple, Samsung. This is where we continue to see this movement, and we're used to getting things for cheap, and that is starting to pivot, which is why there's so much investment and look at Companies from Taiwan and South Korea continue to dominate that foundry business, which is why we're looking at building more foundries. Where are they building? Which is why China's doing it. We'll talk about that more in segment 5, because they're trying to find ways to mitigate and adjust some of the supply chain. Now, it's important to understand that there's already foundries under development and being built. They were supposed to come on by 2023. So we were supposed to get tight, just because we get a little bit tighter, then new supply comes on, and then that loosens a bit, and then you manage that with utilization rates. But because of COVID, because of raw material shortages, because of supply chain shortages, because of water shortages, and because of a demand surge that happened from potential sanctions with Huawei and new phones set up with 5G coming through, this became a big demand cycle. And again, this created a lot of the shortfall that we really haven't seen catch up yet. So then when you look at the patiently waiting, the lead time for chips surpassed their 2018 peak in February. And now it's 15 weeks. So typically, you order your chips for about 6 months lead time. So the 6 months lead time, you order and then you start to get deliveries. And now you can see that you're getting this bigger and bigger disconnect. And just based on what we've talked about previously and other shows, obviously the Suez Canal didn't help. This is only getting much worse and is continuing to lengthen. And again, coming back to PMIs, that's exactly what we're seeing in general. So when we look at the overall investment and sales of semiconductors have grown over the past decade, and just based on, now if you have a smart home, you have chips in your that are Wi-Fi connected in your light bulb and in all types of just things that were typically simplified, which is going to push this to the upper end when you look at automotive, when you look at computing, but also wireless technology and wireless communications and consumer electronics. Consumer electronics is going to be that bigger side with wired communications, really the biggest growth driver when we look at what is 2021, 2020, and really beyond over the next decade is going to see a lot of that acceleration in general. So then when we look at chip power, obviously chips continue to become a bigger part of a car. All automotive electronics in 2000, 18% of total car cost. In 2020, it's 40%. So if things and think about from 2000 to 2020, how cheap some of this stuff has gotten and how manufacturers were like, oh, well, this was initially in a BMW 7 Series and a Mercedes AMG, and it's now in a Toyota Honda, a Nissan, because the price got cheaper. So it was easier to embed some of these, but now you're starting to see some of that reverse, which again is going to increase the cost of these goods. Again, moving into those cost increases that are going to hurt individuals. Now, when we look at U.S. Corn exports, so corn exports came down, still seasonally all-time highs. But when we start looking at the most recent data sets on where have we progressed on plantings, we're well behind, which again is just right now we're limit up on all of our grains, and this is Wednesday when we're filming. So again, these are going to be things. Now we're having Russian issues, we're having Latin American issues, though they're finally starting to catch up a bit. But they're not on the corn side, which is why corn remains elevated. But right now we're seeing some of that pressure in soybeans because Brazil is starting to catch up, which has slowed down some of the purchases from China, from the US. But again, these are things that are going to continue to reverse. We're going to continue to see this trend higher in general, which is why when we start looking at, well, as all of this stuff increases, as all of this stuff moves through, we have to finance these new levels of payment. And this is just looking at how much paper has to come to market. This is, so on the left, you're just seeing the amount of paper that is going to come into that the U.S. has to issue and the bid to cover. So as those numbers increase, we're seeing a decline in the amount of people willing to bid on it. So if people aren't willing to bid on it, well, what does that do? Well, that puts pressure on just what is happening in general. So if pressure comes into the ratios, as that pressure mounts, that's going to drive up interest expense. So that's going to drive up interest rates, which is interest expense, which is making it more expensive, which then pulls up what is the mortgage 30-year mortgage rate look like? What can India borrow at? Brazil, Russia, China, a lot of these key countries that when you look at, especially from a food side, and then just what does that cost look like? This is where we continue to see a lot of these pressures to the upside. And then when we look at, well, it doesn't mean that people don't want to try to find yield. So U.S. junk bond issuance hit a new record in the first quarter of 2021 because even though the rate of change is aggressive and has moved up exponentially, it's still cheap. So you have guys looking to capture this because they see the writing on the wall and they want to try to get some of this debt on the books at a better interest rate before it starts to drive higher. Guys are looking for yield and they're willing to take down some of this additional debt. So then when we look at, okay, well, what is happening at the banking level? Because when we look at just the amount of commercial banks that are just taking down new debt, that's where we start to see some of these shifts. And you start to see just the commercial banks have a lot of deposits, but we're not seeing it get invested. We're seeing getting stuck at the bank and not being moved through the system, which is what they're trying to counter. But it's also not evenly distributed because when you look at who has the most household wealth or income increase, it's at the top 10%, while the bottom 50% still continue to struggle. So the savings rate, while looking impressive, it is very much weighted towards one side of the level versus the overall evenly distributed view. So there's still a large amount of Americans that are still under pressure. And just to drive home that fact, let's look at disposable income. So disposable personal income has increased 8% over the past year, but virtually all of that is due to government aid. So when you look at compensation of employees is down, capital income is down, pre-existing automatic stabilizers, unemployment, new fiscal reliefs, tax benefits. So everything the government has done has generated your disposable personal income. How can that be maintained? How can that be a continuous? This is why we keep talking about the unhealthy move and the unhealthy assumption on GDP unless we start to see in compensation of employees increasing. And now when we look at the amount of unemployment, the difficulty of getting jobs, not that jobs aren't available, but they're just that people don't have the right training for them, which means that you're going to get hit on compensation. And then there's going to be an efficiency loss at the employer side, which they need to compensate. And this is where we continue to see the pressure. This is a chart that I think really highlights how bifurcated this is and why we continue to be fairly concerned on where growth is. Or I shouldn't say that because we're going to get a surge. There's going to be spending. People got stimmy. But what is the follow-on effect? What is that component? And this is where we continue to see that pressure, especially as our bills continue to mount and we have to borrow more. So then looking at it a little differently, personal spending was weaker in February at negative 1% versus a positive 3.4%. Worst monthly drop since April, but at level remains below full pandemic recovery, but still strong. So when you look at spending, there's a lot that comes into that. Obviously, this was February. There was weather. There was some slowdown ahead of stimulus, and now that it's here, we expect this to see a bit of an increase. And this is why when we look at personal income, you had that huge drop, but now we're going to get that surge because this is, again, looking at Feb, which means that the stimulus checks haven't hit yet, and this will increase that personal income as we talked about when some of those increases come through. But consumer spending recovery continues to be sluggish, especially as you look at service spending. And now that when you look at the backdrop going forward, when we look at price increases and passing through those price increases, how much is the dishwasher going to be? We've talked about it in previous cycles and previous shows, and now there's more data coming out that promotions are starting to slow down. Corporations can't push through as many buy one, get one free or buy one, get one half off because they need to protect that margin, and they're trying not to push through as much of this price increase as possible. But when you look at this, you're going to start to see these increases in prices, which again is going to weigh on how the consumer is spending. So then when we look at this from another perspective, when we look at just the trade balances, U.S. trade deficit widened to the largest on record in February, $86.7 billion versus $84.6 billion. Imports were down 1.4% to 216, but exports were down 3.8%. And this is what the widening continues. So we keep going to the import market. We keep importing. We still have those struggles with the supply chain, which again is driving up costs. Those costs are going to have to get passed through, because we continue to be in a struggling state. And then when that, again, now wrapping this all together into a nice little package, the forward break-even inflation rate is consistent with 2.1 to 2.3% core PCE inflation 1 and 2 years ahead. I would say that this is going to continue to push higher, especially given everything that we talked about. But this is some of the expectations that we're starting to see come into the market, which is why there is that inherent bid behind the yield curve and just where we see rates going in the near term. And then if we shift this a bit and look at the COVID-19 basket, shows a higher rate of inflation. The rate of inflation is accelerating, especially when you look at basic needs. When we start weighing in diesel, gasoline, and other pricing, this is just pushing up. And this is, again, looking at February. So COVID basket crosses 2%, and we think it's going to continue to cross and easily reach 3%. And then when we look at that commercial paper outstanding, you're going to see that more and more is that we're seeing foreign, we're seeing financial and domestic, that you're seeing more and more financial paper go out to try to close some of these near-term funding gaps, because we continue to see some pullback on revolvers. We continue to see a movement on, well, what is the first lien, second lien? What does the bond market offer? But there is a demand for short-term paper when we look at the repo market, the short term, within 366-day market, which is putting some of this commercial paper out there and then having some pretty healthy buyers. So then when we look at that jobs tracker, just to say, okay, well, what's going to happen going forward? Here's where you see that there is some acceleration for what the JP Morgan is saying on the jobs tracker, looking at alternative data on total employment. The expectation is for a fairly sizable acceleration. The difference, here they're coming with about 901,000 will be added. This is something that I think is going to be closer to the number, just based on when we look at restaurants in the service sector, we should see some of those additions in general. And then wrapping it up on total card spending based on aggregate Bank of America data, 1 year and 2 year percent changes. Here's when you start to look at those changes on the 2 year average, just to try to take away some of those increases that we saw, obviously on the base effect. But we're still seeing that net increase on households who didn't, or households who received stimulus payments 2 years. So clearly you're seeing that buying that is accelerating, as we've been talking about. But it's not the money isn't going to go as far. 2, there's a base effect here. And then when you look at just the recipients in general, because when you look at for all households due to base effect, but stimulus recipients 3.0, 3 also showed a surge in the 2 years. So again, you're starting to see that surge, but it's a pop and fade, which just like what we had in April. This one we think is going to be a bit faster, just based on price changes. And again, as we talked about, that loss of income, which is pulling people to pull from savings, which this is just going to go to replace that. So these are those headwinds that we continue to see, and why we really think the inflation pressure continues to the upside.